All right, every single warning light is flashing red. Russia's war on Ukraine, an uneven recovery from the COVID-19 pandemic and a drought across much of the continent have conspired to create a severe energy crunch, high inflation, supply disruptions, and enormous uncertainty about Europe's economic future. Governments are rushing to try to help the most vulnerable amid the nervous confusion. There is broad agreement on one thing: a recession is coming, shortages are coming, equity markets are in shenanigans, and above all, bond markets are sending signals to the investors. Central banks are becoming hawkish, and governments are trying their best to maintain macroeconomic stability. And where do we go from here? Joining us this morning, Shan Said, Chief Economist, Juai IQI. Good morning, Shan. Thank you so much for joining us. Shan, first of all, this is from the Economist magazine latest issue. This scenario you have been sharing with the press and media is becoming a reality. What's the outlook for the market, and what does the bond market telling us right now, Shan?
I think a year ago, the bond market was sending a clear message that central banks will eventually raise interest rates. And now it is happening right in front of us. Fed has raised 225 basis points. And in the next 5 months, we expect the Fed will raise interest rate by 100 basis points. So I think the debt market has been sending clear signals, and I have been sharing that if you want to understand what is happening right now in the market, you just need to follow the debt market, because if you follow the debt market, it gives you the forward guidance on recession. It gives you the forward guidance what the central banks will be doing about the yield curve. At the start of the year, the US 10-year was trading at 1.55. It's now trading at 3.19, almost up 105%. So I think those sophisticated and smart investors who have followed Juai IQI and the newsletter, they already know that whatever we have shared is all documented and is coming to the market. And I think Fed will continue to stay hawkish at the end of this year, and we might expect QE5 coming to the market by next year as well.
You've just mentioned the inverted yield curve. So tell us, how many countries have inverted yield curve at the moment? What's the interpretation of these curves for investors who are watching us, 1970 or worse, since you have mentioned in your newsletter in November 2020 about stagflation?
I think right now many countries are, the yield curves are inverted, as you rightly pointed out. Right now, US, UK, Canada, Germany, Australia, New Zealand, and South Korea. These countries' bonds are in inverted yield curve. What does it signify? It signifies that investors are looking for short-term yields, which are higher than the long-term yields. Investors, they don't have confidence in the long run. So that's why they want higher rates in order to cover themselves. As far as 1970, yes, we are in 1970. The only variable that is missing is the COVID. In 1970, we did not have COVID. We have oil shock. We have higher interest rates. The economy was meaningfully moving into recession, and the same is happening right now. But I think in 1970 was a bit mild, but this 2022, it will be even severe than 1970. But the similarities, the analogies are more or less the same. But the way central banks and the governments are moving, we expect the global economy will not be able to recover before 2025. So it's a very high-end game, and a lot of policymakers, especially in advanced economies, they are in a very perplexed situation as they don't know how to bring back economic confidence. And above all, as Najib mentioned at the start of the program, macroeconomic stability has become the key. So wherever you have macroeconomic stability, the GDP is on the upsurge, the investment is coming, and the consumption patterns remain pretty strong. So I think macroeconomic stability remains the key.
Shan, if you look at the trend right now, shocks of the of inflation, recession, and also geopolitical risk, and if you look at, according to the latest report from Bank of America, it says that investors can expect a paltry 4% price returns over the next decade. Positive, yes, but well below the trend of returns. What's your take on this?
Yes, I think I totally agree with that. The Bank of America in the last 2 years, they have made great calls. if you see the latest graph that Bank of America has shared, the S&P 500 and the yield curve, they are moving in opposite direction. So they have inverse relationship. And as long as Fed will continue to remain hawkish, S&P 500 will stay low, and the valuations are becoming quite questionable at this point of time because valuations are still very high. So I think we foresee valuations going down further, and we expect that Fed will have a hawkish stance. So yes, Bank of America has made the right statement, and I agree with that.
So definitely yen has touched 140 against USD on Friday. The yen slump is now its worst on record, at least going by peak to trough decline since Japan introduced the floating rate system in 1973. So the embattled hashtag currency has lost over 46% of its value against the dollar from its 2011 peak, a steeper drawdown than the 45% slump it experienced during the time of the late 1990s Asian financial crisis. So, Sean, what's the outlook of the Japanese economy?
I think Japanese economy continues to remain under a lot of pressure, as you rightly pointed out. Yen has been a real shenanigan this year. It has lost 27% of its value against USD. So the question the investors are asking, with depreciating yen, can it turn around the economy? It's a huge question mark. I don't foresee the Japanese economy making a turnaround. Even the Japanese yen is going down further. So the question that I have been asking with some of my networking, that are we heading back to 1985 when Japanese yen was trading at 240 against USD, and then the revaluation of yen was done and it came back to 140? Are we heading to the same scenario? Premature to say, but the way yen is moving, I wouldn't be surprised year-end yen is trading between 145 and 150. Japanese yen making a turnaround, I doubt at this point of time.
Shant, according to Financial Times dated August 24th, 2022, Italy is one of the most indebted nations in Europe, with its public and private debt surpassing 330% of its GDP, according to IMF data and EPB macro research. Shant, Italy is clearly in depression, as it has had weak or negative growth over the past 10 years, and with no indication that growth will resume soon. Consequently, if you look, investors believe Italy to be the most vulnerable to the ECB's plan to dismantle its stimulus, starting raising interest rate, and also stopped bond purchases, supporting the country's enormous debt market. Thus, if we look, 39 billion euro were backed by hedge funds in August 2022 in anticipation of Italy's default. S&P Global Market Intelligence calculated that way. What's the future of Italy in that sense, and can PM, the Prime Minister Mario Draghi, pull it off with his financial acumen and also strategic thinking?
I think Mario Draghi pulling it off, it's quite an arduous task. It's quite uphill for him to make a turnaround. Italy, not only Italy but also Europe, they are in huge low growth situation, and to turn around from here with conflict of Russia and Ukraine is making a huge impact, and the economy overall, Eurozone, is dragging down. So I think Italy is quite vulnerable, and hedge funds are betting against the Italian bonds. So I think at this point of time, I would say Europe remains under a lot of pressure, and it will require 2 to 3 years for Europe to make a turnaround. So if you look at some of the growth areas, Asia is still in front. Europe is struggling, US is struggling. I wouldn't be surprised if Euro stays low for the next 2 to 3 years. It's quite an uphill task for Europe.
Shan, briefly, should we brace for impact, especially for Asia?
Asia is still in the growth mode. 9 days ago, I was in Cambodia. The economy is on the upsurge. The consumption pattern, the investment are coming in a big way. Same goes for most of the countries like Philippines, Vietnam, Malaysia. As long as consumption is there, as long as investment is there, these are the two major components. And the third variable that is very important, trade and commerce. So if your consumption, investment, and trade and commerce are on the upsurge, the economies will, ward off recession. And it all boils down to one thing. If governments can maintain macroeconomic stability, investors will have confidence. And if you look at Malaysia, the GDP number for second quarter, 8.9%. Same goes for Philippines, Indonesia. Vietnam, all these economies are on the upsurge. And I have shared in your last program that I wouldn't be surprised ASEAN and Asia would be leading the growth recovery for the global economy.
Sean, last but not least, if you look at what the Fed, has and will aggressively hike its interest rate, many sees it as, the Fed's way to let the recession happen as soon as possible before they can move forward with the economy planning and all that. Do you agree with this statement?
Yes, now, Najib, this is the most talked about subject that with Fed raising interest rate, so the economy goes into the slow growth mode, recession happens, consumption goes down, eventually prices will come down. So in order to tame inflation, which is pretty high and it will continue to go high. If you look at Guardian newspaper last week, Goldman Sachs has predicted that UK inflation will touch 22% in January 2023. So inflation will remain pretty high, especially in advanced economy. So the only game in town is to induce recession. Once you induce recession, the growth slows down, the consumption patterns goes down, prices come down, and eventually inflation will come down. But again, I would say it's not that easy. Every policy lever that the central bank undertakes, it makes 12 to 18, 15 months for that policy lever to make an impact. I wouldn't be surprised that advanced economies will have recession for the next 2 years.
Sean, I do understand that, raising interest rate to tame the demand and subsequently, curbing the inflation high raising right now. But if you look at the current situation, the problem is not because of the demand, it's because of the disruption of the supply chain and the input costs and so on and so forth. But do you think that, raising interest rate is the best mechanism we can do right now to tame inflation?
Yes, Najib, this is the only strategy that you have to tame inflation. Otherwise, inflation is running away. And as you rightly pointed out, there are supply chain hiccups, there are shortages coming into the economy, the demand is coming back because of post-COVID. So I think the only strategy that the central bank can undertake is through raising rates. This is the only option that they are left with. But again, it will not happen overnight. Inflation will remain. So inflation will come down eventually after 18 to 24 months. It's not going away soon.
All right, Sean. Thank you so much for joining us this morning. Sean Said, Chief Economist Juai IQI, berkongsi pandangan dan juga idea dan juga strateginya dan juga untuk melihat keseluruhan keadaan inflasi yang tinggi pada ketika ini. Thank you so much, Sean.